Hi and welcome to In Perspectives for this quarter. I'd like to run around the world and tell you what I think is happening and also then relate that back to what I think is likely to happen to asset prices. The global economy continues to run at a well below trend pace. If we go around the world, in particular the US, it has averaged somewhere around the 2.3% growth level over the last year. And there are a number of positives and negatives which are influencing growth as we move forward from here. On the positive side, we've seen lower oil prices, and that lower oil price has boosted consumption, and it's likely to continue to lend a little bit of a hand to consumption as we move forward. On the investment side, we've seen energy capital expenditure, which has fallen by about 30% over the last 6 months of this year, start to reduce in its negativity, and therefore the rate of detraction from growth through the investment cycle is likely to begin to abate. Government spending should begin to turn positive, having been a drag over the recent past. On the tighter side, or on the downside, lending standards are likely to tighten from here. Asset values, which have increased quite considerably over the last couple of years, are unlikely to rise at the same rate that we have seen, and think of the US share market in that instance. More recently, we've seen a lot of volatility arise because the market has been thinking that that the Federal Reserve is going to tighten interest rates. Well, when they do finally tighten interest rates, that's likely to be a headwind for US growth. Let's have a look at what's happening in Europe, because like in the US, in the short term, the euro area is being helped by a lower oil price, a weaker euro, and really a thawing of credit markets, which had become quite tight over the past year. These benefits are likely to wane as well, whereby the markets will again focus on the region's debt dynamics. And as a good example, Italian government debt to GDP is heading towards 130%, which is going to act as a headwind for the economy. Whilst over the longer term the macro dynamics don't really look good, when we start looking at markets, there certainly seems to be a lot of bad news that is factored into share market prices, and we'll talk about that in the last couple of slides. Over the longer term, though, there is a real risk that the debt dynamics within euro will continue to come to the fore, and what that means is that the European Central Bank will find it almost impossible to prevent a Japanese style debt deflation spiral, which means that they will be printing money for a long period of time. Let's have a look at what's happening in Japan. The Japanese economy continues to face numerous challenges, most significant being the ageing population, as we all know, and high government debt to GDP ratio. The high government debt will limit the ability of policymakers to pursue easier fiscal policy, meaning that quantitative easing, also known as money printing, will continue for the foreseeable future. Japanese exports Japan, I should say, exports capital equipment to the emerging markets, where risks there appear to be elevated. In particular, and this is mostly outside of Asia, emerging markets seem to have come under a little bit of pressure, especially given that the resources boom has come to an end. Those countries that remain most at risk look like being Turkey, South Africa and Brazil, and any further deleveraging is likely to impact those economies. The key question here is how emerging market strains will affect developed markets, and it will be through two ways particularly. One will be through trade flows, and the other one will be through the financial sector. So slower demand will hurt exporters in developed economies that conduct business with those developing or emerging markets, and slower emerging market demand puts downward pressure on their particular currencies, and upward pressure on developed market currencies, making developed market exports like Japanese capital equipment exports more expensive. So you'll get a natural slowdown there. In China, there's little doubt that the Chinese economy has weakened. Part of the slowdown reflects falling external demand from other emerging markets, and part reflects the government's anti-corruption, and finally another part reflects the transitioning of a very export-orientated economy to one that is much more focused on consumption and services. Policymakers have reduced interest rates, fiscal policy has eased, the yuan has depreciated further, and because of these factors and the ability to actually use policy in order to stabilise the economy, I think that the Chinese will avoid a recession or a hard landing. In Australia, the Australian economy continues to rebalance away from mining, as we know has been doing that for some time now. We've slowed to an annual growth rate of somewhere around the 2.3% level, and when I use my Goldilocks analogy of not too hot, not too cold, just right, we are running on the too cold side. What does that mean? Well, it just means that inflation will stay low and unemployment will stay fairly high, and it causes a dilemma for the Reserve Bank. It wants to cut, the Reserve Bank wants and should probably cut interest rates to promote more business investment, but unfortunately if it does so, it's probably going to cause further upward pressure in an already heated housing market, and the last thing that we need is to go the way of America and Japan when it comes to residential real estate. I'm not suggesting that we will, but it's certainly in Melbourne and Sydney in particular, and less so in Brisbane, it certainly seems to be quite a heated market. Now, growth in Australia is not strong enough to generate, as I mentioned, meaningful employment growth, and we haven't seen the lights of the car companies shut their plants down, particularly in Victoria over the course of 2016, which will still put upward pressure on unemployment. So there is a good chance that interest rates will stay low for quite some time. The investment outlook for mining remains bleak and unlikely to turn anytime soon. But one of the key positives that I have seen recently is that tourism is definitely on the rise, which is good, particularly for our northern states. So what does this mean for the financial markets? Well, interest rates throughout the world will remain low for quite some time. The next interest rate move in Australia will likely to be down. If there is a move, there is no chance, I don't see, of interest rates going up, not at least for the next couple of years anyway. Share market dividend yields since the correction, they were once again looking fairly reasonable relative to interest rates on offer within the cash and bond markets. Dividend yields have been restored, and I quite like the Australian share market from here. Low inflation globally suggests the bond yields there overseas will remain low. Despite seemingly expensive valuation, there's just no impetus for them to be rising. Once again, I look at the interest rate outlook around the world, and I look at listed property trusts, and I think that the yields there have improved anywhere above the 5.5% up to 6% level for certain property trusts. Still look attractive in my mind. And finally, when I look at overseas share markets, share prices look to be fair. As I mentioned before, they look to be cheap in Europe. And if there is any fall in the Australian dollar from here, it would be very favourable for long-term returns from overseas shares. So I hope you've enjoyed my latest update. I look forward to speaking to you again at our next update. Thank you. Bye.